What's up, everyone? Welcome back to Cash Flow Catalyst, where we help you grow your wealth and take control of your financial future. Today we're talking about the 10 most common investing mistakes and how you can avoid them. The good news is, they're totally avoidable with the right knowledge. Whether you're just starting out or already investing, avoiding these mistakes can help you build wealth faster and with less risk. Let's jump right in. Mistake number 1 is not having a solid plan. You might be excited to dive into the market, but without a strategy, you're setting yourself up for failure. It's like trying to build a house without a blueprint. Things are going to get messy. Before you even think about buying stocks, bonds, or anything else, you need to define your goals. What are you trying to achieve with your investments? Are you saving for retirement, a down payment on a house, or your kid's college fund? Once you know your goals, figure out your risk tolerance and time horizon. Think about it like this. You wouldn't go on a road trip without knowing your destination, right? Investing is no different. Take the time to create a solid plan and you'll be much more likely to reach your financial destination. Next up, trying to time the market. It's tempting to think you can buy low and sell high, but in reality, nobody knows exactly when that will happen. Not even the pros. The market is influenced by so many factors that trying to time it is like trying to predict the weather months in advance. Instead of chasing the elusive, perfect entry and exit points, focus on long-term investing. This means choosing quality investments and holding on to them for years, if not decades. Remember, time in the market is often more important than timing the market. One of the best ways to take advantage of long-term investing is through dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach helps you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost over time. Stick to a long-term strategy, utilize dollar-cost averaging, and you'll be well on your way to building wealth over time. Mistake number 3 is putting all your eggs in one basket. A common rookie move is investing heavily in one stock or sector, especially if you see it doing well. Think back to the dot-com bubble in the late 90s. People were pouring their life savings into internet stocks, convinced they were going to get rich quick. And when the bubble burst, well, let's just say a lot of people learned about diversification the hard way. Diversification is key to minimizing risk. You want to spread your investments across different assets, stocks, bonds, real estate, and even international markets. That way, if one investment takes a hit, your entire portfolio won't go down with it. Imagine your portfolio as a basketball team. You wouldn't want a team of all point guards, right? You need a mix of players with different skills and strengths. The same goes for your investments. Remember, diversification is your best defense against market volatility. It's all about managing your risk and protecting your hard-earned money. Chapter 4. Ignoring fees and costs. Fees and expenses can eat away at your returns, and ignoring them is a huge mistake. Whether it's mutual funds, ETFs, or even trading fees, it's essential to understand what you're paying. It's like that annoying delivery fee when you order food online. It might not seem like much at first, but it adds up over time. Always compare the expense ratios and management fees of different investments. An expense ratio is an annual fee charged by mutual funds and ETFs to cover their operating costs. The lower the expense ratio, the better. Management fees are charges for the professionals who manage your investments. Again, you want to keep these as low as possible. Over time, these seemingly small costs can add up and take a significant bite out of your gains. Imagine that $50 being reinvested year after year, compounding over time. That's money that's staying in your pocket and working for you instead of going towards fees. Don't be afraid to shop around and compare costs. It's your money, and you deserve to keep as much of it as possible. Chapter 5. Emotional investing. We've all been there, panic selling when the market dips or buying in during a frenzy. Emotional investing is dangerous. Making decisions based on fear or greed can lead to major losses. Think about it. When the market is crashing and everyone is selling, it's natural to feel scared. But here's the thing, when you sell in a panic, you're essentially locking in your losses. On the flip side, when the market is going up and everyone is making money, it's easy to get caught up in the hype. The key here is to stay calm and stick to your strategy. Remember your investment plan? That's your roadmap to success, and you need to stick to it, no matter what the market is doing. Remember, the market is a roller coaster. It's going to go up, it's going to go down, and sometimes it's going to make you want to throw up. But if you can stay calm and stick to your plan, you'll be much more likely to reach your financial destination. Chapter 6. Chasing high returns. Another big mistake is chasing high returns. We've all seen those hot stocks or investment trends that seem like they can't lose. But if something sounds too good to be true, it probably is. There's no such thing as a free lunch, and there's definitely no such thing as a guaranteed return in the stock market. Instead of chasing the next big thing, focus on building a balanced portfolio with a long-term outlook. This means investing in a mix of different asset classes like stocks, bonds, and real estate, and diversifying within those asset classes. Remember, slow and steady wins the race. Focus on building a solid foundation for your financial future and tune out all the noise. Chapter 7. Failing to rebalance your portfolio. Over time, some investments in your portfolio may grow faster than others, which can throw your asset allocation out of balance. Failing to rebalance means you might end up taking on more risk than you originally planned. Think of it like this: you wouldn't wear the same clothes in the summer that you do in the winter, right? You adjust your wardrobe based on the changing seasons. Well, you need to do the same thing with your investment portfolio. Rebalancing is the process of bringing your portfolio back to its original asset allocation. This might involve selling some of your winners and reinvesting that money into your laggards. It might sound counterintuitive to sell investments that are doing well, but it's an essential part of managing your risk. Let's say you started with a portfolio of 60% stocks and 40% bonds. After a few years, the stock market has a great run, and now your portfolio is 80% stocks and 20% bonds. To rebalance, you would sell some of your stock holdings and use that money to buy more bonds, bringing your portfolio back to its original 60-40 split. Set a schedule to rebalance your portfolio, whether that's once a year or after significant market movements. Relying on hot tips from your Uncle Sal or social media hype is a recipe for disaster. Not doing your own research can lead to costly errors. Remember, it's your hard-earned money on the line, so you need to treat it with respect. Before you invest in anything, take the time to understand what you're investing in. Don't just blindly follow the crowd or listen to someone who claims to have all the answers. Always look into a company's financials, management, and industry outlook before investing. There are tons of resources available to help you research investments, from company websites to financial news sites to online investment platforms. The more you know, the better equipped you'll be to make informed decisions and avoid costly mistakes. With 24/7 news cycles, it's easy to get spooked by negative headlines. But overreacting to every piece of market news can cause you to make poor decisions. The media thrives on fear and uncertainty, and they're always going to sensationalize things to get your attention. One minute they'll tell you the market is about to crash, and the next minute they'll tell you inflation is out of control, and you need to buy gold. It's enough to make your head spin. But here's the thing: most of it is just noise. Instead of getting caught up in the daily noise, focus on long-term trends and tune out the short-term fluctuations. Remember, the market has always gone up over the long term, despite wars, recessions, and all sorts of other crises. Finally, not considering taxes when making investment decisions is a costly mistake. Remember, capital gains, dividends, and even interest can be taxed. The government wants its cut, and it's up to you to minimize your tax liability. Make sure you understand how taxes will impact your overall returns, and consider using tax-advantaged accounts like IRAs or 401(k)s. These accounts allow you to grow your money tax-deferred or even tax-free, which can make a huge difference in your long-term returns. For example, if you invest in a Roth IRA, all of your earnings will grow tax-free, as long as you follow the rules. That means you won't owe a dime in taxes when you withdraw your money in retirement. It's important to consult with a tax professional to understand the specific tax implications of your investment decisions. Remember, it's not what you make, it's what you keep. So there you have it, 10 common investing mistakes and how you can avoid them. Remember, successful investing is all about patience, discipline, and having a solid plan. Don't let these mistakes derail your financial goals. By understanding the pitfalls and adopting a thoughtful, long-term approach to investing, you can set yourself up for success. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss out on our future content. Thanks for watching, and I'll see you in the next video.